Welcome to this training. In this video, we are going to discuss the terms, the languages of Forex trading. Let me tell you, failure to understand any of these terms means you can never make money from the market. It's as simple as that. The terms are like the names. And if you don't understand these technical things, hardly will you make money from the market. I do tell people, Forex is for the intelligent. Now, who is the intelligent or who are the intelligent? These are people that persistently study over and over until they get hold of what they want to learn. So, if you are watching me and you think you are not intelligent, you are. But it will take a lot of effort. After all, you are not the founder of the Forex. You are not the founder of these terms. So you must get conversant with them to speak the language of the Forex before you can make money from it. It's as simple as that. So we are talking of Forex trading terms. Today I'm going to list 16 terms you must understand as a Forex trader. The first one is pips. The second one is bid and ask. The third one is lots. The fourth one is lot size calculation. The fifth one is pip value calculation, leverage, bull market, bear market, stop loss, equity, margin, free margin, spread, candlestick, chart and pattern. These are basic terms. There are thousands of terms, but as a beginner, you must understand this as listed here. So let's move on to demystify each and every of these terms and how they apply to your sources of making money in the forex market. What is PIP? PIP stands for percentage in points. Yes, what it means in a layman terms is the slightest movement of price movement, the slightest movement of it is called pips. Yes, it is the smallest unit of price movement in the forex market. It measures how a currency pairs changes. That is, if a value of currency pair is 1 and the market moves to 1.1 or 9 points, then that difference is what we call pip. How to understand the pip? In most currency pairs, a pip is the fourth decimal place. Yes, for example, Euro USD, this symbol, Euro USD, if it moves from this price, 1.1234 to 1.1235. Now, there is change. Remember I said is the fourth decimal. Which one is the fourth decimal? For those of us that are not good in mathematics, the decimal is counted from the point. So 1, 2, 3, 4. So this is the fourth decimal. So the difference in the fourth decimal, the fourth decimal of this is 5, and the fourth decimal of this is 4. So 5 minus 4 is 1. So the pip, in this case, the currency moved 1 pip. That is just it. However, other pairs any pair that involves Japanese yen, the pip is measured in the second decimal, which is this. So, for example, if USD JPY moves from 110.25 to 110.26, that change is 1 pip. Remember, we say it is 2 decimal. That is, we are talking of the 26 minus 25. That is pip. You can make your further research. There is no way this training will be all you need, but it will give you 90% foundation you need. So that is pip. Whenever you hear a trader says, I made 2 pips, I made 10 pips, I made 15 pips, that means the market moves 15 or 16 places off the original price, either downward or upward. That is exactly how you measure pip. Why do pip matters? Pip are used to calculate profits or losses. Yes. For instance, if you buy Euro USD at this and you sell at this, the price has increased by 10 pips and your profit is based on this movement. Look at where you buy. Remember, is the difference between the 4 decimal, this 40 minus 30 is 10 pips. That is how you calculate pips in Forex. That's why it matters. It tells your profit or your loss. Quick summary. A pip is the smallest price change in the currency pair. It's as simple as that. In most pairs, 1 pip equals to 0.004 decimals. For JPY, we are talking of 2 decimals. Pips help traders measure how much the market moves and calculate their gains or loss. It is a fundamental term, and understanding it is key to you grasping what Forex is all about. Now, the next is bid and ask in Forex. What is bid and ask? Yes, it's like ask is simple English. Asking price, selling price. That is exactly what it means. It's just the price. Bid is a price at which your currency pair is being priced at any given time. Yes. Once you want to sell your currency pair, somebody will want to buy it. The price at which that person wants to buy it is usually the bid. Now, the ask is a price which you are willing to pay for a currency pair. Are you getting it? Once you want to buy currency pair from anybody, the person will give you an asking price, then you will bid. Usually, the bid is usually lower than the asking price. This is normal economics, normal market. The bid price is always lower than the ask price. Now, the difference between the bid and ask is called the spread. We'll get to know more about what is spread. But know that the difference between the price, the asking price, and the bid price of a currency pair is called spread. Practical example. For Euro USD, the bid is 1.1500. That is the price at which they are willing to buy your currency pair. And the ask price that you are asked to buy is 1.502. Now, the difference between these two prices is what is called the spread. As I said, we'll talk more of this. What is the key takeaway? The bid is for selling and the ask is for buying. What is lot size? You said, I'm trading 5 lot size, 6 lot size. What is it in the market? This is very essential. I said you must take note of every terms we are talking about now. Is what is lot size? Lot size is the number of units. If you are buying shares in the market, they will say you buy 10,000 shares, 5,000 shares. That's the language you use in the stock market. But in the Forex market, it is called units. Yes, it refers to the amount of currency that you buy or sell in Forex trader. It determines the size of your position in the market and directly affects how much profit or loss you can make per pip movement. Yes, the amount. In stock, we call it the share, your share of a company that you buy. But in Forex is the quantity, the unit of that currency pair you are trading. The unit that you buy for yourself is called the lot size. The higher the lot size, the more money you will make or the faster you will lose. It's very essential because it is part of the risk management. There are 3 types of common lot sizes. Standard lot size. When you buy 100,000 units, 100,000 shares of a particular unit of a currency, it is called standard lot size. Yes. At this point, each pip movement is $10 in most currency pairs. This is 100,000 units of the base currency. That is called standard lot size. Now, mini lot size. This is when you buy 10,000 units of the currency, the base currency. We are talking of mini lot size. Then we have in this case, each pip movement is $1. Then we have the micro lot size. This case is buying 1,000 units. In this case, we are buying 1,000 units of that base currency, and each pip movement is $0.1. Remember, pip is each movement either upward or downward. If it moves in your direction, if you are buying micro, you are gaining $0.1. If it is losing, you are losing $0.1 per each movement. That is lot size, the quantity of the base currency you are able to buy from the stock, from the forex market. This is the example. If you trade one standard lot of euro USD and the price moved by 10 pips, remember the price moved by 10 pips, and we said in a lot size, each pip movement in standard lot is equals to $10. So how will that affect your money or your currency if it moves in your direction? How will it affect your currency? Now, 10 pips times $10. Remember, we said each pip is $10. That means you make $100 profit. Is that clear? If you trade 0.01, which is micro lot size, and we said what is the value of each pip at 0.01, we said is 0.10, and you move 10 pips, so you make $1 for the movement of the micro lot size in 10 pips. In summary, the lot size determines how much you are trading and the impact of each pip movement on your profits. That is exactly about lot size. Why does lot size matters? Choosing the right lot size is important because it's all about risk. The larger the lot size, the potential of making much money. Yes. At the same time, it's the same risk. The risk of losing your money is high. Yes, that is it. So you want to know how much you expose your money, your capital to the market. So that is why it matters. Beginners often start with smaller lot size to manage their risk while learning. Yes, as a beginner, don't be greedy. Just start with small lot size to grow your capital to where it's supposed to be. Lot size calculation. Yes, as a beginner, you must learn how to calculate the lot size of the currency or of the amount you have. What am I saying? Let's assume you have $1,000. What is the maximum or the best lot size to trade to ensure that you did not lose all your money in a very short movement? That is what I'm trying to calculate. But as time goes on, if you progress or when you find yourself in the master class, you must not do this calculation to know the lot size that you have to use in your trading. Before calculating your lot size, you must decide how much you are ready to lose in the market. If you have some money to trade with, you must predetermine, okay, I have $1, I have $2, I have $10, I have 5 Japanese yen. No matter the currency you are trading, you must first of all assume, okay, I'm comfortable with losing some percentage of money. As a rule of thumb, not a rule of thumb anyway, but most traders are comfortable with risking 1 to 2% of their account per trade. So in that case, for example, if you have a $5,000 account and you are risking 2%, your risk per trade is 2% of $5,000, which is $100. Hope you've gotten it. So you have $5,000 account, and you want to start trading. Now you want to determine the lot size. The first step to do is how much are you willing to lose per trade? From 2% assumption, you are ready to lose $100 per trade. So in that case, what do you do? Step 2, you determine your stop loss. At what point will you place the stop loss? We will discuss stop loss as we progress, so that when it gets to that stop loss, when it gets to that point, the market will close automatically. You will determine that. Now, how many people will you set as a stop loss? That is what you determine. Now, a stop loss is the amount of price movement you can afford to risk before exiting the trade. Yes, as a beginner, I don't want to make it difficult. I want to make it clear. Stop loss is just a feature where you can tell the market, if you lose, if my money gets to this particular point as a loss, close the market. Let me go and replan or re-strategize. So at that amount you are ready to risk per trade, you translate it to pip and you say, okay, at 20 pip, I've told you the value of each pip. If it is standard lot, it's micro, if it is mini. So at this point, take me out of the market. Let's assume you are trading Euro USD and you set your stop loss at 50 pips. Calculate the pip value in this case now. The value of each pip depends on the currency pair you are trading, which we have discussed previously. For most pairs like Euro USD, 1 pip in a standard lot is $10. For different lot sizes, standard lot size is $10 per pip. Mini lot size is 0.1, which is $1 per pip. Then micro lot size is 0.1 per pip. I hope you've understood these things. So you want to calculate the pip value of the money you are ready to lose via the lot size. So how do you calculate the lot size? Because remember, we are dealing with $5,000 and you want to trade a lot size that will not expose the capital to the market. So now what do? Lot size is equals to risk amount over stop loss, that pips, times the pip value. This is all I'm explaining. This is where it is. Now, let's calculate. Risk amount is $100. That's 2% of $5,000. The stop loss we said is 50 pips, isn't it? Now, pip value, we are trading standard lot size. So having gotten all these things, and you do your calculation here, you will have 0.2 mini lots. That is what you will trade for a 5,000 account and ready to lose 100%, ready to lose 2%, which is $100 of your capital. It's as simple as that. Based on this calculation, you should trade a 0.2 lot size to risk no more than $100 of the market if the market moves 50 pips against you. Remember what I said, as a beginner, take your time to digest these things. I said intelligence comes from constant or persistence practice. So if you're a total beginner, or if you have been trading and you've not paid attention to these things are one of the reasons you have been losing money from the market. This formula helps you manage risk and choose the right loss size based on your account size, stop loss, and risk tolerance. Now we move to pip value calculation step by step. You want to calculate pips, the value of a pip. Apart from what I've said, you want to know, if my market move a pip, what am I making? Now you said identify the currency pair. That's the first step. Let's use Euro USD currency pair as an example. Use the formula for pip value. The formula for pip value is equals to 1 pip times lot size divide exchange rate. That is exactly what you have. Now remember, we said 0.001 is the lot size for most pairs, excluding the one having JPY. I hope you remember. So 1 pip is 0.0 this in a standard account. Exchange rate, the currency price of the pair at a particular time. So Euro USD is trading for 1.1500. For a reminder, this means that 1 euro is equals to 1.500 US dollar. That means if you have this value in dollar, you can get 1 euro. That is what it means. That's the exchange rate. So, lot size, the size of the trade, e.g., 100,000 units for standard lot, 10,000 for mini lot, and 1,000 for micro lot. So, let's do the calculation proper. Let's assume you are trading one standard lot of Euro USD at exchange rate of this. You remember our formula? Yes, our formula is pip value is equals to 0.001, the exchange rate, and the lot size, which is 8.6956 USD. That is the value of 1 pip. So for every 1 pip movement in Euro USD, you will gain or lose 8.70 approximately. That is the simple way to calculate your pip value. But let me tell you, as a beginner, know all these things. When you become very professional, these things you don't need to do this calculation. They will be coming, you know them. You understand the language they speak. So try and do this to know if you understand what I mean. A trader is trading USD JPY with a lot size of 0.02. The lot size has been given to you. He sells at 145.485. Yes. And the current price is 1435.07. How many pip has he gained? And what will be his gain in dollars? The money, the value. So this is classwork, but I would like you to remember it is a USD JPY pair. We measure pips at the second decimal place. I'm giving you this as homework, classwork. The next thing, if you don't understand it, go back, follow the other processes we've done. You will get clear. And I'm telling you, if you take time to master this, you are a money. Because it seems it has become that the Forex world is sinking deep in you. So that is the assignment. What is leverage? What is leverage? If you have been seeing adverts, Forex adverts, this is one of the factors they use to sell. They said you have a leverage. In fact, this time around, most brokers give unlimited leverage. So what is leverage proper? This is the financial support. This is borrow. This is the lend. A broker says, come, I will borrow you money to trade. It's as simple as that. I will lend you money to trade. From my dashboard here is an optional financial support broker lends to trader. I said it's optional because it is not compulsory for you to take the leverage. If you have enough capital, you may not need the leverage. But that is the main selling point. Yes, it is an act of borrowing money from the broker to increase your position in the market. That is leverage. How does it work? Leverage is expressed in ratio. Yes, this is it. Such as 50:1, 100:1, or 500:1. What this means is that for each $1 you have in the market, you can control $500. Yes, you can control $500 worth of currency. That is what it means. But it sounds so sweet. It sounds so true. But there is a lot of problem here. So you must pay attention to what I'm about to discuss in leverage. You see, somebody calls you and says, come, bring $1 and I will give you $500 to trade, equivalent to trade. Then check that business thoroughly. So leverage is something as a trader you must be very conscious of. For example, if you have $1,000 in your account and use 100, the leverage you are using is 100:1 leverage. This means you can control 100,000 worth of currency in the market. Hope is clear. Remember, each $1 you have can give you $100. So when you have up to 1,000, it will be 1,000 divided times 100, which is 100,000 worth of currency you can control in the market. Why is leverage important? It allows you to magnify your gains with small investments. With $1,000, you are controlling 100,000 value of currency. That is leverage for you. That means you can access large and potential earn. Your earn could be higher when you use leverage. Cons: as good as it is in magnifying profit, that is exactly how it is good in wiping out your account. If the market moves against you, you could lose all your initial investment. And let me tell you, the borrow or the leverage the broker gives you, you remember it is his own, and yours comes in. He brings his own, you bring your own. But once the market goes and wipe out your own, the broker will tell you, I am off the market, and you will lose. Leverage is very, very dangerous for a beginner. So, as an advice, when you get to the master class, we will discuss, okay, what leverage is good for you to trade or how to trade a leverage. If you have 1,000 in your account and use leverage of this, you can trade a position worth of 100,000. 1% price movement in your favor will give you a 1,000% $1,000 profit. 1% price movement. But if the market moves 1% against you, you will lose your 1,000, wiping out the account. That is how leverage works. Key takeaway: leverage is a powerful tool that can increase both potential profit and risk. It should be used carefully, especially if you are a beginner. Pro tips: as a beginner, avoid leverage at all costs. Avoid leverage at all costs as a beginner. That is it. Now, how do you set this leverage in the market? This is exactly how you set the leverage in the market. You want to know how you put the leverage in the market. Sorry. Let's go on how we put the leverage in the market. You can see, watch this video, and you understand. Talking about leverage, you want to know how to set your leverage. Get your leverage in the market. So now we are talking of bull market. What is bull market? A bull market refers to financial market where the price is going high. When the currency pair, the base currency pair, is going higher against the secondary pair, it is called bull market. When the market is going higher, it is called bull market. This means that the value of particular currency or currency pair is increasing over time. So whenever you hear that the currency pair or the market is bullish, then the market is going up. A lot of factors drives this market upwards: economic indicators, investor optimism, or positive market sentiment. Now, characteristics of a bull market: rising prices. The main feature of a bull market is consistently increase in price. Yes. Strong demand. More buyers are in the market than the sellers. So the buyers are pushing the price higher. That is the bullish market. Optimistic sentiment. Investors believe that the market will continue to go up, fueling more buying. These are the characteristics of bull markets. Example: if the Euro USD currency pair is in a bull market, the price of the euro is consistently increasing relative to US dollars. So that is all about bull market. Why does that matter, or why it matters? In a bull market, traders look for opportunities to buy, hoping to profit from the rising market. Do you see why it matters? If you are unable to identify that the market is bullish, you cannot make money. Identify a bullish market early is important to capitalize on upward trend. That is why it matters. The opposite of the bull market is the bear market. Yes, that is directly opposite of the bull market. Characteristics of the bear market: the price is falling. The main feature of the bear market is steadily decreasing in price. The price keeps decreasing. Weak demand for that currency. Yes, there are more sellers. People are selling more than buyers, causing price to nosedive. Pessimistic sentiment. Investors expect the market to continue going down, which often lead to more selling. Now, what is stop loss? What is stop loss? This is a feature in the trading platform that allows traders to place a condition that when the market is against me to a particular level, go out of the market. So it's a risk management tool found in the platform that automatically closes a trade when the market moves against you by a certain amount, but you will be the one to set it. Though it automatically closed the trade, but you will be the one to set the stop loss. So that is why I call it stop further loss, because already you must have been losing, but you tell the market, okay, when you get at this particular point, exit me from the market, let me re-strategize. It limits further losses. Are you seeing it? By exiting the trade at a preset price level, you are the one to set it, ensuring you don't lose more than you can afford. How to stop loss? Okay, how a stop loss work? How does it work? The stop loss. When you set a stop loss, you choose a price at which your position will automatically be closed if the market moves unfavorably. This protects you from significant losses in volatile market. Yes, it protects you from further losses from the market. For example, if you buy Euro USD at this price, one is 1.1500, and set a stop loss at 1.450. If the price falls to this, your trade will automatically close, limiting your losses to 50 pips. I hope you are getting it. You buy at this price and the market and put your step loss. What it means that you said, okay, this market will increase. But if it did not increase from this point and it goes down, you said, okay, if it goes 50 people more than I can afford, let the market close. That is how it works. So it is a risk management feature on the platform, which you can see. This is a video on how to set the platform, how it works. This is the video. Now, why is stop loss so important? Risk control. It helps you manage risk by capping how you are willing to lose on a single trade. But let me tell you, in my masterclass, you will learn how to trade without this feature. You will know why I don't like it. Yes, I've been telling you it is good for risk management, but there is a better way you can manage your risk than using stop loss. It prevents emotional trading, yes, because you have already said if you lose, if the money goes below so amount, I'm ready to go out of the market. So you can comfortably go out of the market, leave your chart, hoping when it comes to where you are comfortable to lose, it will go out, it will go up automatically. But if it doesn't, the market will go in your direction. Take away. A stop loss is crucial for protecting your account and managing your risk, especially in unpredictable markets. Every trader should use stop loss to avoid significant loss. Every beginner, let me put it this way, every beginner should use stop loss until you master how the market works. And in that case, you may not need stop loss to trade. What is equity in the market? Equity is as simple as that. It refers to the total value of your trading account. Yes, including your account balance and any unrealized profit or loss from open trade. It represents the current real-time value. Now, this is what it means. Assuming you fund your account with $1,000, Your account, you fund it with $1,000 and you enter trade. In that trade, you have a loss of $200. Now, what is your equity? Equity is the balance plus the floating profits or plus floating loss. That is equity in the Forex market. Formula: equity, account balance plus unrealized profit or loss. You understand? If you're in the market, you may be selling or may be buying. The market may be against you or in favor of you. You have your balance. So that balance plus the floating profit is what we call equity. Account balance, the amount of money your account without considering open trade. That is what we call account balance. The amount of money in your account without considering open trades. You know, equity is account balance with the value of the opening trade. But in this case, account balance is the money in your account when there is no trade. Are you getting it? So I think that is clear on what is balance. Unrealized profits and losses. The current profit or losses or loss of open positions which has not yet been closed. Those positions has not yet been closed. Now, let's say you have, let's look at this example. Let's say you have $5,000 in your account and open trade with a profit of $500. Equity value will be what? Remember, your balance plus floating profit or loss. So the profit that is floating here is $500. So your equity value is $5,500. What is margin? Margin in Forex is the amount of money a trader must deposit to open or maintain a trading position. Let me explain this where you understand it more. When you have a $5,000 account and you are on a leverage of 1:100, that means you have a leverage. For you to use that leverage, you must bring your own part of the money to the market, to the trade, because already you have funded your account, but some percentage of the money need to trade. So that percentage of the money you give out to the trade is what we call margin. When we get to the platform, when we get to the Forex trading platform, you will see more of these things. But just make sure you understand what I'm doing here now. So that is margin. It is essential. It is essentially a good faith deposit that allow you to control some position. Yes, it is some deposit, some part of your money that allows you, because you will not put all the money to trade. Some percentage will go to work for you. So that percentage that you want to send to go to work is what we call margin. Note, margin is tied to the leverage a trader uses. It's as simple as that. How margin works? When you use leverage, your broker requests a certain percentage of the total trade size as collateral. Are you getting it? Which is called margin. This amount is set aside from your account balance when you open a trade. That is how it works. That means your counterpart funds to trigger the leverage that you need to trade with. That is exactly how it works. If your broker offers 100:1 leverage, you need to provide 1% margin of the trade size. Any trade size you pick, 1% margin. If you want to trade a standard lot of 100,000 units of Euro USD at 1:1, 1.1500, the required margin will be 100,000 times the price, which is this. This is what you need. This is the required margin. Part of your funds to give you the money you want. With this leverage, you need only 1% of this, or $1,150 as margin to control the 150,000 position, 115,000 position. Hope is clear, very, very clear. So that's the 1% of the total value the leverage gives you. You deposit it, or it goes into work to give you what you want. What is free margin in Forex? You know, the other one is margin, but now we have free margin. Assuming you have $10 and 1% of that $10 has gone to trigger your leverage, you are left with some money now untouched in your account. That is what we call free margin. In that case, you can start a trade with it. Free margin is the amount of money in your trading account that is available to open a new position or sustain existing ones. That is why you can see in some people can open up to 5, 6, 7 trades in one account because their margin can allow them to open more trades. That is what we call free margin. It is a difference between your equity, yes, and the margin currently being used for open trades. The total balance in your account. That is the difference between your equity and the margin. So that is the free margin that you need. So at any given time, you can be trading and you have your free margin and you see another opportunity in another pair, you can still open trade. As I earlier said, that is why you can trade up to 5, 6, 7 open trades in one account, is because you have free margin. When you don't have free margin, you can't trade. You will hear insufficient funds. Formula: free margin equals to equity minus used margin. All these things are found on the platform. You will see them in the platform. When we go to the platform section, you will see all these things live. Yes. So this is how you determine your free margin. In fact, they are automatically calculated by the system. So once you look at your platform, you will see your equity, you will see your used margin, and you will see your free margin. Example: if you have 5,000 equity in your account, 1,000 used margin for an open trade, free margin should be 5,000 minus 1,000, which is 4,000. So with 4,000, you still have the ability to open other trades. If you have 4,000 available to open a new position or sustain losses on current trades, yes, once the free margin can help you sustain the market you are into or even open a new trade. What is margin call in Forex trading? Now, you know what is margin, you know what is free margin. Now, when does a broker offer you a margin call? Now, when you have many open trades, that means you have used your margins. You have used your margins, and the market is not going in your favor. The broker will tell you, will give you a call because the lines will turn red. It will give you a call to say, hey, you have no free margin, and the margin you've used, the market is going against you. Close some of your trades so that you will have support in the market. That is what we call margin call. A margin call occurs when your account equity falls below the required margin needed to keep your open trades active. Yes, it's as simple as the explanation I did. When you no longer have margin, free margin to sustain your trade, the broker will tell you, go out of some of these trades so that you will have breathing space. Essentially, it is a warning from your broker that you don't have enough funds to support your current position and you need to either add more money or close positions to avoid further losses. That is what a margin call is. How a margin call happens: leverage and margin. When you use leverage to trade, your broker requires to maintain a minimum margin level, which I've explained, often some percentage of your capital. Now, losses accumulate. If the market moves against your trades and your account equity decreases, the broker will issue a margin call. If your equity falls below the maintenance margin level, you will be called upon to do what? To either add more money to have equity, to have the margin, or to close some of the trades. So from what I've been saying, you understand that it is very dangerous to open several trades in the market. When you come to the masterclass, you will learn how to trade without experiencing margin call. Because what happens is that once you don't fund the account or close part of the trade, the account will be wiped. That's how we call account blown away. Let's say you have, practical example, let's say you have $1,000 in your account and you open a trade using 100:1 leverage, controlling a position of 100,000. The broker may require you to maintain a margin of 500. The broker will issue a margin call if your open trade causes loss and your account equity drops below $500. So remember, in this setup now, you are controlling a position of what, of $100,000. But the rule is that you must maintain a free margin of $500. So if the market is going against you and it falls below $500, then you will experience what you call margin call. What happens during margin call? You either deposit more funds, yes, or close excess positions you have, or the broker will automatically close some of the positions for you to prevent further losses. Why does it matter? It protects you. A margin call protects you from losing more money than you have in your account. Yes, when there is a margin call, you can fund your account to have a balance. That is if you are sure the market will go in your direction. But if it is obvious that the market is not in your direction, close all the markets even. You'll be left with some money. So margin call matters because it tells you a decision, a speed decision to take. Risk management, as I said, it's a signal that you need to better manage your risk or reduce your position size. So that is why it matters. Whenever you see, how do you know a margin call? There is a red line. A red line will appear at the terminal of your platform, which I will explain when we go to platform. Yes. So it is a sign that your market is not healthy. Your trade is not healthy. So what is spread? This is another essential term that you must master. Do you know why? If you have been following brokers, what they always advertise is tight spread. Some even say zero spread. What is it? It's very, very essential. You must know it. This is the difference in prices between the bid and ask. I've said it in the beginning of this video. Yes, it is the beginning. Sorry, this may be the longest video you watch, but it's very essential. Please stick to it. So the difference between the bid price and the ask price, that is the spread. And that is where the broker makes his own money. So whenever you hear spread, know there is a difference between buying and selling, or between the buying price and the selling price. And that is where the broker makes his money. In other words, that is the cost of trading. That is the cost. That's what it will cost you to enter a trade. That's why even if you enter a trade at a particular price, it will not show you at that price. It will go higher. Whatever price you enter the market, it will go higher. That means the broker has taken the difference. That is why whenever you enter the market, you must start with a negative and moves up. How spread works? Bid, the price at which the broker is willing to buy the base currency from you. Lower price, yes. You know the bid is usually lower. Ask price, the price at which the broker is willing to sell the base currency to you. Higher. Are you getting it? So the difference between the bid and the ask makes the spread. That's where the broker makes their money. So some brokers make it so wide. And when the difference is so wide, you will hardly be in profit. So you must get a broker that has a tight spread so that with little movement, you'll be in profit. Spread, the difference between the ask price is usually measured in pip. Yes, it's usually measured in pips. Some brokers 2 pips, 5 pips, 10 pips. The higher the pips, the more dangerous it is to trade with that broker. The smaller the pip, you know that, okay, it will cost you 2 or 3 pips to enter a trade. So that is it. That's where the broker comes into play. Though as time goes on, you will know the best broker for you, because I will guide you in a masterclass to use the best broker that will surely make you money. Practical example: if the Euro USD pair has a bid of this is the bid, and the ask price is this, what is the spread? The spread is the difference between this pair, these two, and that is what the broker makes money. That is it. This is the difference, and 0.02. Remember, we said in a standard account 0.001 is the value of 1 pip. So this is 0.002. So 2 pips, which is very okay as a trader. Types of spread: we have fixed spread, variable spread. Now, what is fixed spread? As the name implies, the spread remains the same regardless of the market condition. This is typically offered by brokers who act as market makers. Don't bother about this. I will explain it in other videos. Types of brokers. But these brokers, they have fixed price, fixed spread, while other brokers, they adjust the spread based on market condition. That is what we call floating spread. The spread changes depending on the market volatility and liquidity. That is the different types of spread. Which one is better, you will know when we progress. For you as a beginner, why spread matters? You know, it's a trading cost. You will not want to spend so much money in trading, or the cost of trading. So it represents the cost of opening a spread. The smaller the spread, the lower the cost for you as a trader, as a beginner. Please pay attention to this. And also, it impacts your profit, as I said earlier on, because once it is a tight spread, you will easily be in the profit if the market moves in your favor. Takeaway: the spread is a fundamental concept in Forex, representing the cost of entering a trade. It affects your potential profit, and it is an important factor when choosing a broker. You see, it affects your potential profit. So you must understand spread as a beginner before you start trading. But however, since you are with me, I will give you the best. I will tell you how to choose pairs, currency pairs that has or have little spread or little pip difference from the buy or from the ask and the bid. Now we've come to a candlestick. What is candlestick as a beginner? Candlestick is type of stick used in forex trading that represent price movements within a specific period. Each candlestick shows 4 key pieces of information. Let me tell you, I am a successful forex trader today because I can read candlestick. So pay attention to what I'm about to explain here. Candlestick. Remember, as a forex trader, all you are doing is to buy low and sell high. So what are we talking about? We are talking of difference in price. Difference in price. That is what we are talking about. So candlestick, from today, start learning to understand the candlestick, because that is the language you will always be seeing as a forex trader. We have the open price of every candlestick. We have the close price. We have the higher price, and we have the lower price. These are the 4 sections of a candlestick. Let's look at it practically. Look at the structure. Now, this is a bullish candlestick. When we talk of bullish, we are talking of buy, isn't it? Now, This candlestick, when it is buy, it is going up. When it is bearish, it is coming down. So look at what happens. It opens here. The price opens here and come down a bit. The price opens at this level and come down a bit. Then start moving up again. Start moving up, and got to this. This is the highest price this currency pair get for the day. Now, and it drop a bit and close here. So this is the lowest it go for the day. This is the opening. This is the lowest it goes for the day. It goes through all these prices to this point high and closes this. This is the bullish candle. Now the bearish candle is usually it opens up. Remember, bearish we are talking of down. Now this it opens here, and when it opens there, it goes up a bit. Now the buyers push it up a bit. Now the sellers push it to this point, which is the lowest it went to the day, and close here. This is candlestick. This is how it works. These are the four components of a candlestick. Takeaway: candlesticks help traders visualize price action and make informed decisions by showing how the market moves within a given time frame. From candlestick, we form chart pattern. Now, the candlestick series of candlesticks form what we call chart pattern. A chart pattern is a specific shape or formation of price chart that indicates potential market direction. Chart pattern: the candlesticks form the chart pattern. Series of candlesticks form the chart pattern. These patterns help traders predict the future price movement based on historical data. So, common chart patterns. We have so many chart patterns, but in this course, I will just introduce you to a few, which is head and shoulder, signal a potential trend reversal, double top, double bottom, indicate possible change in direction after a failed test of price level, triangles, show consolidation before a breakout in either direction. Takeaway here: chart patterns are critical for technical analysis, helping traders spot trends and make educated prediction about price. That is the common chart pattern. We have so many of them, but as a trader, you must master some. When you come to my master class, you will know what I trade, the pattern I trade, how it works for me. So that is the common chart pattern. So mainly most successful traders trade using chart patterns and candlestick. Head and shoulder, let me show you an example. This is a shoulder, this is head, this is shoulder. So you see, and the market moves. This is sample of head and shoulder. This is double bottom. This is what? Double bottom. You see bottom one, bottom two. Now, this is series of candlesticks that forms this double bottom. This, we've come to the end of the chart Forex terms, basic Forex terms. If you are a total beginner, take your time and watch this video. Understand these terms, make them part of you. If you don't understand them, I bet you from experience, you can never make money. These things are the languages you have to understand. You have to speak like a financial expert. You have to speak like a Forex trader before you start seeing the money flowing. Thank you for watching. Let's move to other video. For getting to this point, obviously, you are ready to make money in the market. Thank you.